also the Medicare 3.8%. I'm not sure, maybe someone could research this for us for this week or next week. Would that apply here? Let's say your child, the kiddie tax applies because your kid has $10,000 of unearned income, and you are subject to the 3.8% Medicare tax on unearned income. Would that also apply to the child whose income you're picking up? I don't know that answer because this is the first year we really had that 3.8%.
So if two parents are divorced and they're each claiming a child, whatever child has income over $1,000 have to go to the parent.
It sounds like, yes, if they were splitting it up, that's right. It goes on the return of the person who claimed that child as a dependent. So there, I mean, not for the exam, but there could be some real cans of worms here, couldn't there? Just some thoughts, just some thoughts. But now let's go back. We're still not done with this area. Then we'll talk about filing status. Tax returns, remember we said the exemption is the greater of earned income plus $350 or $1,000. Now we're talking about earned income. I had a student at the O'Hare Center before they got a full-time, Stanley Robertson, now was full-time accounting faculty there. And he said his child earned $5,000 as a child model. You know, modeling, I don't know, clothing for some catalog or something. So, let me see. It says here that you get the greater of earned income, so that was $5,000 plus $350 up to the maximum allowable standard deduction. So that basically would be what, $5,350. So that child's standard deduction would be $5,350. But what about this? Let's say that child had earned $10,000 modeling for a catalog. So $10,000 plus $350 would be $10,350, but that child is single. So what's the maximum standard deduction for a single person? That's the $6,200. So notice it would be the $6,200. So if the child, and you say, well, Bill, how could the child have that much income still be your dependent? You're banking the child's income. You're providing the support for the child. You don't expect a 5-year-old to support themselves. So you take the earned income, add the $350, but make sure it doesn't exceed the filing status of single basic standard deduction. I was thinking of two examples the other day. Macaulay Culkin first. That was the kid whose parents were all screwed up. Remember the Home Alone films? So they were actually, he was probably supporting them because they took all his money to not just take care of him but themselves. But then I was thinking of Dakota Fanning and how her family life was pretty decent, and she was making big bucks when she was real young, and they kept that money on her behalf, so she would be like the $6,200 even though she earned more than that. Now, filing statuses. I just want to comment on these briefly. We're kind of getting close to the end, so we almost finished on time today. Some days I may need a little extra time, and no extra tuition for the extra few minutes, by the way. But your heads are probably overwhelmed right now with stuff. Let's talk about head of household, and let's talk about surviving spouse, because these will also be on the exam, and these can be a little confusing. There may be someone in here, usually, what's the normal situation where you have head of household? Yeah, a single mom. I mean, it could be a single dad too, but it's usually a single mom. Exactly. But there's other situations as well. Let's kind of take a look at this. This is paragraph 3345, but as I found the other day, you got to scroll because there's no page numbers. I'll have to mention that to my buddy Patrick again. All right, okay, let's skip through the hogwash. The dependent must be a qualifying child or a qualifying relative of the taxpayer. Well, I guess that means no multiple support agreement or class 9 people. Over 1/2 the cost to maintain the household must be furnished by the taxpayer. Household must be the principal place of abode for more than half of the year. Let's stop there. let's say your dad has been deceased, your mom is a widow, but she's not eligible yet for Social Security or Medicare, and she's not Medicaid eligible. So you have her in an assisted living facility, and you're basically paying the bills. Now, she would be your dependent, because a mother would have to be your dependent for you to have head of household. For head of household, the relatives have to be your dependent. The exception is a qualifying child. But wait a second, they're at the Sunrise Assisted Living. They're not living in your home because they need extra care. It says on that page that some of you will be able to find, the taxpayer's dependent parents need not live with the taxpayer. This is below example 3.14. Need not live with the taxpayer to enable the taxpayer to qualify as a head of household. Skip a sentence. The father or mother must occupy the household for the entire year. A rest home or home for the aged qualifies as a household for this purpose. So if on the exam, your mom is your dependent, but she's in a nursing facility out of necessity.
And you're paying.
And you're paying for it. That's why she's your dependent. You can file head of household filing status even though you're a single person. Because it'd be you, a personal exemption, you got the dependency exemption for your mom. Now, the aunts and uncles and the nieces and nephews and the brothers and sisters, notice they have to be your dependent for you to have head of household. But the child situation, remember we talked about that. We talked about the divorced couple, the mom with the custody of the child, but she doesn't get the dependency exemption because the father gets it. She can also get head of household because a qualifying child does not have to be your dependent, but all the other people do. All the other people do.
Can I ask you a question?
Sure, go ahead.
What about this? What if a woman gets divorced with a couple kids, moves in with her parents, but pays for everything for the kids, all the food and all of that?
Interesting perspective, because it could happen. The only problem I have, and maybe someone can correct me here, is that she's not really paying for maintaining the household. Who's maintaining the household? She's paying for all the kids, and she might be contributing to the food, but if she paid rent to the parents. It's a gray
area though, but what if the house is paid off? There's not really a lot of household expenses.
Yeah, but and now I may be wrong. This sounds like it could be a very practical situation. Maybe someone can research this and put it in the online discussion on one of the computer screens. Because it seems to me that if she's only paying for a portion of the food or her kids' clothing and school fees, she's not really paying the cost of maintaining a household. That's what disturbs me a little bit. Now, if the house were fully paid for and she was contributing, let's say, like a rental fee for the rooms that they occupy, or paying a proportion of the real estate taxes, I think she'd have a stronger argument. Yeah. But I'm not sure. Yeah. That might be something which you could find in a revenue ruling. But that's a very easy situation.
I think you should be paying rent or something.
I do too.
But it's still kind of a grayish area.
But it's an area that comes up. There's a lot of these people, they get divorced, the mom is trying to maintain, it's hard to get child care and stuff and to be able to work, and so they have to move back in with the parents, whether it's one parent still left or two parents. So I think this is a very typical type situation that could easily occur, especially if you got 2 or 3 kids. How are you going to have them cared for and try and work and be able to afford an apartment or something? So, but yes, I think that would be true, but someone can find something more in that. That's an excellent observation. I mean, we have so many changes now in things. People used to stay married even if they were miserable. Or I remember as a kid, you went to the Hallmark shop and it was, happy anniversary, mother and father. Now I go to the Hallmark shop, happy anniversary, father and his wife. or mother and her husband. I mean, those things are so many different now. And now we have the same-sex couples and households and so forth as well. So, I mean, things have really changed. Now, surviving spouse. Be cautious here. Well, Bill, her husband died and she's still breathing, so she's the surviving spouse. Well, and that'll happen on the exam, unfortunately. I got the term where that happened. A woman's husband died, you know, and then it turns out here that she's surviving another 2 years, and we want to know about her filing status. The surviving spouse filing status is very limited. We already said that the year your spouse dies, what's your filing status the year your spouse dies?
Married filing
Married
joint.
filing joint. How many personal exemptions? 2, you and the dead spouse. But in the subsequent years, if you don't have a dependent child, what would be your filing status? Single. Here's old Mrs. Smith here. Her husband died. Now she's at the bar drinking Jose Cuervo and dancing on the table every night. Yeah, she's a single person. Because now the surviving spouse status says that if you are, in other words, a single person now, and you have a dependent child, not parent, not aunt or uncle, not niece or nephew, only a child, and here the child has to be your dependent, then you get to use the married filing joint rates for 2 more years. So that'd be a total of 3 years. But that's all. So in those subsequent 2 years, you'd have married filing joint rates. You'd have 1 personal exemption only. You don't get the dead spouse those subsequent 2 years. And you'd have to have at least 1 dependency exemption. And that would be because you have to have a dependent child. But if on the exam you're widowed, you have a daughter, but maybe she's living with you, but she's not your dependent, your filing status would be single. And you'd have just the 1 personal exemption because your daughter is not your dependent. Daughter probably has too much income. But when you talked about people moving back in with the parents and things, this is very typical now as to what's happening because of the state of the economy. That's one reason you're here, so you don't have to do that. You know, hopefully you'll get these massive, you know, with this new degree and things, get these promotions and the big bucks and everything here, so that you won't have that problem. Other questions or ideas so far? Because we're almost done. I'm just kind of wrapping up here, enjoying your company. Okay, just a few last points. This is where we stopped on Tuesday, but let's say a person had 0 taxable income or a loss. When would they still be required to file a tax return? This is on page 319 or section 3375. And for those who have to scroll like I did the other day, it's near the end of the chapter. When would you have to file a tax return even if you had 0 taxable income? Well, it would be in a situation in which you had a proprietorship. And on your Schedule C, you had net earnings of $400 or more. Now that could be wiped out as far as taxable income, but why would you have to still file a tax return? There's 0 income tax due, but what is due? Your proprietorship, Schedule C. Well, you have to pay self-employment tax because remember, proprietors are self-employed. Here at the Keller School, it used to be, and this is a violation of the payroll tax regs, that all non-full-time faculty were treated as proprietors. They got 1099s. Now they've broken that out. We have visiting professors who get a paycheck and a W-2 every 2 weeks, and the adjunct faculty are the ones who get the 1099. So if you're adjunct faculty here at Keller, and I'll bet down the road, some of you in this class, or at least one of you, will graduate and will basically come back and start teaching here, and you'll be one of Bill's old alumni here, because there's a whole bunch of mine who are teaching at different locations. So basically, because you got to pay self-employment tax. If you're self-employed, you're the employer and the employee. And you pay the FICA tax, the Social Security and the Medicare and all that stuff, and you have to pay it via your income tax return. But you can't just pay it on April 15th. You should be filing quarterly estimates, the 1040 ES. And that would be April 15th, June 15th, September 15th, and then January 15th of the following year. You also have to do that for the state. I used to have to file estimates because I had some investments. I don't have to file estimates anymore because they're all making less than 1%, so I don't have to do the estimates. Other questions or ideas here? I only went 10 minutes over today. By the way, the week that we have the food next door, we'll have to go till 9:30 that day because I insist on enjoying the food and the games. Well, they don't have that at the Loop. They usually have a little piece of candy or something. You know, they give you one piece or a cup of water or something, and that's it. But here they always have soups and the little games and everything. So.
What week is that?
It's usually week 5 or 6. Is it 6 here?
It's 5 at this point.
It might be 5. It's 5 or 6 based on the location. But, I always look forward to that. I always try and make sure that if I'm not teaching the Loop one of the nights, I get to come here, mingle with the students, enjoy the soup or the chili or the pie or whatever they have. Other questions or ideas? Everyone was happy about today, hopefully? Take a look at Chapter 3 now that we've gone over it in depth. Not just for the exam, but for your own knowledge, because the exam is a little bit more straightforward. You can skim Chapter 4 and 5. I don't think you need to read the word for word, so we'll be ready for next week. Look over your notes that you had with that homework ES. Let's just add 2 more last minute points here. This is miscellaneous stuff for the homework ES, or the put down and this was one of the topics I put in the online discussion. Amortization of intangibles. Sorry, I said close up and I'm opening you again for 2 minutes. Amortization of intangible assets, such as goodwill. Amortization of intangible assets, such as goodwill, are amortizable over 15 years, amortizable over 15 years per Code Section 197. 197. Let me just comment a second. For years, goodwill was not amortizable for tax. I argued with the IRS because we would acquire a company and I'd have an appraisal done, and the IRS said you assigned too much of the purchase price to assets that were depreciable. And they say you should have put most of it in goodwill because goodwill was not amortizable. Now it's a different story because goodwill is now amortizable for tax over 15 years, and my students tell me in intermediate now, goodwill's not amortizable for book purposes. Instead, is this impairment theory or something?
Yeah.
Yeah, interesting how things change. And lastly, put down business bad debts. Business bad debts are ordinary loss deductions. Ordinary loss deductions, or ordinary expense deduction. Ordinary loss, I call it ordinary loss, they might call it ordinary expense deduction. And non-business bad debts are, does anyone know, by the way, this is not in the chapters for today. Okay, I don't know where this came from. Non-business bad debts are short-term capital loss. Where did they get that from? Short-term capital loss. I promise to be quiet now. Let you go home and relax. On 720, I think it's 720 radio, isn't it? I think the Blackhawks should be on, if you're interested. I'm not a big hockey